Hey guys, welcome back. This video, I want to talk about everything we saw last week because it was one of the more wild weeks for us memory investors. We had everything. We had volatile swings across the sector. We were down. We were up violently, back down again on Friday. We're going to dive in and talk about exactly what drove that price action. But we also had the biggest tech earnings. The biggest companies on the planet reported out their earnings last week, just gave a tremendous amount of signals for us as investors, better ways to understand what is happening with the AI infrastructure build out. Is it still strong? Should we be concerned about CapEx and free cash flow? Everything was there for us to digest to better understand how this trade is moving forward. And then finally, probably the most interesting story that was happening underneath the surface the entire month of July is this unraveling of a massively leveraged fund on Wall Street called Situational Awareness, and all of the liquidity issues that it created across the entire tech sector and the memory sector as it unraveled and switched hands over to Citadel. So we'll talk about all of those stories on this video because right now we still have a fundamental argument on Wall Street in the investment community. The fundamental bulls, those that have high conviction in the AI trade or the memory sector like myself, we are still seeing an unprecedented multi-year AI hardware shortage. Now, the bears on the other side, the bears are screaming about an over-leveraged bubble and how it's showing its first signs of structural cracks. Which side is right? That's for you to make the decision. But I want to present a balanced argument today. I want to go through the facts of everything we saw this last week for all the stories that I mentioned. And hopefully, at the end, you can make the decision that's best for you and your portfolio. But if you haven't done it already, make sure you hit like. Make sure you subscribe to the channel. Let's see if we can get Market Signal up over 40,000 subscribers with this video. Guys, if you like this content, if you've learned something from watching this channel and you haven't subscribed yet, because about 50% of our viewers haven't, do me a favor, take a moment now and subscribe to the channel. I love for you to be in the community. Let's keep Market Signal growing at the rate we are. All right, let's get started. I want to pull up an article first that just resonated with me this morning when I read it on Barron's, and it probably is going to resonate with each and every one of you because I think we all felt the same way this week. It was an exhausting week. So let me pull up that article. We'll walk through it together. Let's see 5 lessons from an exhausting week in tech and 2 big winners. It resonated with me, not only the title, it's just this first couple sentences. Are you tired? I'm tired. I think many of us, with all of the emotional swings that we had this past week, all of the noise and the signals that were firing at us, it was frankly an exhausting week. We had everything from big tech earnings. We had the second quarter GDP. We saw June personal consumption expenditures, that price index, the Fed meeting and what the decision will be. And I think there's more to come there still. And then finally, this highly leveraged bull position that was liquidated. But as the author mentioned, on Wednesday afternoon, the skies cleared because the evidence remained that the demand for AI services is growing rapidly and it's continuing to outstrip supply. It's exactly what we saw on Wednesday and on Thursday with the big tech earnings. But remember, we also saw it with Seagate, SK Hynix, and Samsung over the past week. It validated for us memory investors that have high conviction in this trade, many of the signals and the earnings and what those leaders of those companies spoke about validated the conviction we have in the sector. But let's go through the 5 that this author calls out. Number 1 is CapEx is paying off. The largest public companies, Amazon Web Services, Microsoft Azure, are on fire. He mentions this is a clear message from the earnings signal that there is real profit to be made from all of the CapEx, that their income statements are now showing a very clear benefit. Great sign for us as memory investors because we know we need to see continued investment in the build out from the hyperscalers. It will drive demand for the memory players. The second signal is software gets a boost. In the latest quarter, Microsoft Business Software segment beat expectations for both sales and operating margin, defying the bear narrative. Microsoft 365 Copilot, their flagship AI software product, is finally starting to gain traction after a slow start. And we also saw Salesforce it demonstrated something very similar with their Agentforce AI software. It saw their ARR go from 440 million to over 1 billion in 9 months. So software isn't dead, according to the author. Meta needs a cloud. Meta has significant investment in their CapEx, up to 145 billion. They are building they're investing a significant amount of AI data center build out, but they don't have a cloud unit to monetize all of that build out. So Meta sales were up 28% from last year. And some of that performance is due to AI, but the mounting depreciation and AI research expenses sent the profit margin plummeting for Meta. So they need a cloud like their peers. Finally, Apple's AI trade-off. So we know for years Apple had squeezed its supply chain suppliers. Well, now they're facing real competition. We have real competition from the AI server makers, and it's swallowing up the output from TSMC and the memory producer. And then the last one is situational awareness. This is the massive $45 billion hedge fund that was unraveled this week, that essentially was sold off the Citadel. I want to get into this story more deeply and show you the impact that it had on some of the memory players like SanDisk, which was a core holding of theirs. So if you're not familiar with situational awareness, let's walk through a couple articles to just quickly bring you up to speed. So this was a hedge fund that was managed by a younger gentleman by the name of Leopold Aschenbrenner. He grew this hedge fund from $200 million to $45 billion, all with bullish bets on the AI super cycle. Let's go through the article. You can see what he built, but he had like July just crushed the fund. All of this was happening beneath the surface. His massive leverage bets on the AI companies, plus the short positions that he had against the software companies, both unraveled, drove the fund down, and ultimately made banks essentially had a margin call on this fund and essentially sold majority of the positions to Citadel. We see that situational awareness had built a concentrated position in one of Wall Street's most popular trades. He was owning companies that were expected to supply the chips, data centers, power, and other infrastructure behind the AI boom, while Leopold was also betting against the software firms viewed as vulnerable to the technology, to the tech disruption. So when we take a look at the last month, if I just kind of go to 1 month in general, month of May, you can see the impact that we had on the hardware companies that he was essentially leveraged in, that he was investing in at 4 times the rate with leverage. And also seeing that the software companies, particularly Adobe, which he bet against, was up 19% in the month. So that short position had significant impact on this situational awareness, the hedge fund. You can see some of the top holdings, the top 10 long holdings, they suffered significant losses. SanDisk right there at number 3, almost just over $724 million was this fund was holding in SanDisk, and it was down almost 57% off of its peak. Had significant impact, and part of the story on why this fund was unraveled and kind of sold off. If we jump over to the Wall Street Journal, they had an article on this yesterday, but there was parts of the article I wanted to call out was really interesting. You could see that everything was going well. It was going right as of early July. This fund was chosen to play as an anchor role in the standout $27 billion U.S. listing of SK Hynix. And for every $1 of capital, situational awareness would upsize its position by borrowing an additional $3 to $4, sometimes more, people familiar with the matter says. So it also used options to amplify its returns. That meant even small declines in individual names could have significant impact on the portfolio. But in the middle of the month, we saw it ourselves. We tracked it on the channel. The sentiment changed in the AI sector, with the AI hardware names. We saw investment, just the sentiment change around the AI trade, and it just crushed this fund. As we scroll down, you'll see that over the what also was interesting is that people started to hear, and this made me think of Michael Burry when I read this part, because it said over the past week, traders at major hedge funds and other firms began sharing information about situational's exposure, with some placing short bets against the top holdings, hoping to profit as Aschenbrenner sold his positions to raise cash. This made me think about Michael Burry and how public he was with his short positions against the memory sector and against other tech stocks. Was he intentionally being that public with it to drive even more and more segment, to ultimately profit from his short positions? But he knew underneath situational awareness was in crisis mode, and they needed to cover these positions. So it just made me think about it. Drop a comment below if you agree with that, if you disagree, but that's where my mind went first. But we could see that the short bets by rivals, they weighed on situational's portfolio. Meanwhile, tech shares like SK Hynix were sliding. In over 3 days, the 3 days that ended on Tuesday of this past week, hedge funds reduced their positions at a scale not seen in years, according to Goldman Sachs. This resulted in this, all this leverage resulted in deep losses. And as they intensified, banks issued margin calls demanding additional collateral to stand behind the loans of stock. Situational awareness dumped stocks to raise cash and ask investors for additional capital. We saw this in the market. You saw them sliding. There was just a forced overhang. There was just a bolus of dumping that was going on that was driving negative sentiment in share prices. And I'll show you that in a moment when we get to the candle chart. But ultimately, it came to a turning point when on Thursday, I think as of Thursday morning, Wednesday night, Citadel worked with situational awareness and they acquired the fund. They stepped in to buy assets from the troubled fund. When I scroll down over here, you can see Citadel landed the deal just before the opening on Thursday morning, agreeing to buy the vast majority of Situational's public stock portfolio. They received a discount over 10% to the market value of those shares, according to someone close to the matter. And for Griffin and Citadel, the deal proved to be just a phenomenal buy, at least on Thursday, as it drove. We saw the massive rallies across the memory sector, across tech sector overall. The semiconductor and other stocks the fund purchased just soared on Thursday. And so let's go in and take a look at some of this dynamics of what essentially happened. If I jump over here, I created this chart looking at SanDisk specifically, because we know SanDisk was a massive holding in this unwind that we saw in the market. And if you take a look at the chart here, I just grew this price range. I put this rectangle in there to show you the drop from where we started on Monday to ultimately where the stock ended on Wednesday. And you can see it had a brutal liquidation drop where SanDisk plummeted 31%, almost $460 had a drawdown in those 3-day period. This grinding sell-off was driven directly by prime broker margin calls, forcing the liquidation of core long equity positions that were held by situational awareness. Now, notice that selling pressure climaxes right at the bottom of that boundary box, right on heavy kind of red volume. You can see that little bit of a green candle at the end, but look at that massive green volume bar that comes up right at the end of the day on Wednesday. This is the exact moment the forced liquidation reached its floor when Citadel jumped in and absorbed the physical share block off the market. And what happened next is marked by that trend line. We saw this 26% jump essentially the next day. So what happened here is short sellers were caught. So they were caught in this violent squeeze. They were continuing to short this position, thinking SanDisk would drive down further and further, not knowing that behind the scenes, we saw this shift, this Citadel jump in and to purchase the volume of shares in these positions from situational awareness, trap the short sellers. And that's why we saw this massive explosion of 26%, sent the shares rallying back up to 1,277 per share. And this was also very similar dynamic that we saw with Micron. You can see Micron beginning of the week where we started, where to Wednesday had a drawdown of just about 20%, $190 on the board. Now, Micron was not a core holding, one of the biggest holdings in situational awareness, but this is kind of sympathy trade. When you're seeing massive sentiment change, when you're seeing kind of selling off, it kind of came across, in my opinion, to all of the memory stocks. They just sold off. Fear, uncertainty, doubt took over. Sentiment drove the stock down. It was momentum that was driving it down. It wasn't fundamentals last week. But a similar fashion, we saw an 18% gain, got the stock 18% gain, got the stock back up to 875. You can see that rally right here Thursday morning when the short sellers essentially got caught and it continued to rally throughout the day. Now, Friday was a different story, and I'll come back to that in a moment. But I want to show you what happened in the Korean market, because we know when we finished the day on Thursday with those massive rallies, it carried back over the Pacific out to the Asian markets, and we saw significant rally with SK Hynix up almost 30% on the day on Friday in their market. We saw Samsung up 27%, and it was looking as if this rally was going to continue on Friday. We saw that momentum just starting to happen in our markets, that pre-market momentum right before the opening bell on Friday. These stocks had significant amount of just coiled action ready to explode at the opening bell. But what happened? It didn't carry over into Friday. This is ultimately the ADR here in the US and where it finished on Friday, it was down 3.5%. But go back to both SanDisk and Micron from their charts. You can see the significant gap up that we had. Look at the gap up. Let me jump over to Micron and talk about that one. I'm going to make it a little bigger for you guys. So let me get rid of some of these graphs to make it easier to see. Now we've looked through that, but take a look at the gap up that we had here on Friday. Just a huge jump. And then we saw this kind of trail down. It just didn't hold the momentum. I think what we saw here is that Friday's dynamics, we saw this massive momentum on the Cosby. We saw those huge jumps with SK Hynix and Samsung, but it didn't rally back to the U.S. market on Friday. Initially, they gapped up, but the momentum stalled by the time, within the first hour overall. And I think what we have to realize here is that Citadel and other institutional desks were trading against Thursday's massive move, that almost 19% move with Micron, 26% with SanDisk. They were trading against it. This was the final trading day of July, a major month-end portfolio rebalancing day. So traders used that morning gap up to lock in profits. They digested the week's gains, and they pulled these pure play memory players back down to technical support levels. And that's what we saw throughout exactly what we saw with Micron and we saw with SanDisk. We see Micron kind of move back to the 820 level here throughout the rest of the day. It digested that profit taking. It digested the other things that were happening, and it just got to the support level of 822. Same with SanDisk, gotten this support level of 1215. So that's what I would call out as some of the dynamics that we saw happening last week. And if we go back to kind of the bull bear case overall, I think the bullish take on this last week is that we have got a structural reset and the overhang clearance out of the market. They will argue that the bulls argue that this collapse was strictly a paper leveraged event that we saw in the beginning of the week, and it wasn't a fundamental breakdown. And I actually would agree with that. We had a toxic 4x leveraged fund that was completely removed from the market. The shares didn't flood the open market. They were quietly transferred to the Citadel fund. And with the forced liquidation out of the way, the stocks were free to re-anchor to enterprise fundamentals, like Amazon's $220 billion CapEx commitment and the Samsung warning that they listed in their earnings around memory shortages that will persist through 2028. So that'll be the bull take on it, is that we have a structural reset. The bear's take on this will be that this is essentially a canary in the coal mine and kind of an inventory overhang. Bears see this event through a much more cautious lens. The bears emphasize that Thursday's monster rally was purely a short squeeze on thin volume, and it didn't represent organic institutional buying. Second, they are more cautious with Citadel because this is a market maker, not a long-term buy and hold investors. Bears argue that Citadel will systematically unload and hedge the newly acquired inventory into future rallies, creating a persistent overhang ceiling. And the last piece is that the bears will argue is that situational awareness, like the memory market is losing one of their biggest buyers, one of their most aggressive marginal buyers. And without synthetic bank leverage driving bids, valuations may need to re-rate down to traditional cyclical level. But that is the bearish view. So the real question we have isn't whether the stocks move this week, because we saw the movement with stocks this week. The real question remains to be answered is whether the price moved because the value changed for these companies or simply because ownership changed. Now, I want to jump back to one other thing that we saw on Friday, some dynamics there, because I think this was also a really interesting question for me. So let's jump back to that piece, because what we did see on Friday, let me pull it up, on Friday is a decoupling within the sector. So we saw Micron and SanDisk down, right? Micron was down by 6%. SanDisk was down by 5%. But we saw Western Digital up by 2% here. You can see 2.2% for Western Digital. And we also saw Seagate up by about 0.5% on Friday when we were seeing that profit take. And the question is why? Why are they operating differently? Why did they decouple? Enterprise HDDs decoupled because they are pure data center. They have pure data center exposure. And they serve the enterprise cloud storage. These enterprise hyperscalers are reaching to these companies, which we know is a triopoly between Western Digital, Seagate, and Toshiba. Western Digital and Seagate have 90% of the market. So with Amazon confirming 37% AWS growth and massive CapEx outlays, enterprise storage faces zero consumer drag. It is 100% cloud hyperscaler demand, keeping both Western Digital and Seagate insulated from all of the other noise in the marketplace. It is a pure driver right now for the demand that we see. And frankly, it's almost a duopoly between these two companies in the market. Now, if we jump back over to Micron, we could say, why did that one operate differently? Why did we see them pull down? We see that DRAM and NAND, they're very much tied to both enterprise strength and consumer demand. There's more caution in the consumer side. So DRAM and NAND are pure play hold. They both hold dual exposure. So cloud infrastructure and consumer devices like PCs and smartphones. On Apple's earning call, there was a clear bearish signal. So Tim Cook went on to say, and what this article says is that he is meeting his match with Apple's memory crunch. And he mentioned how it is hurting the margins. You can see Apple's growth margins actually declined 120 basis points quarter over quarter. And he mentioned how memory is pressuring it. Those component costs are pressuring the margins for these companies. So that is having an impact. And I think that is the bearish signal. They'll say that rising memory component costs are squeezing these margins and raising concerns that consumer hardware makers will cut back volume orders if chip prices stay too high. The bulls on the other side, the bullish argument to that, would they contend that enterprise HBM and server SSD demand is so overwhelming that memory foundries can easily offset any mild consumer softness with pricing in the cloud. So as they shift more to HBM and other plays, they think they can offset any kind of mild consumer friction that we see in the market. But that is the reason why we're seeing some of the pullback with SanDisk and Micron, and in my opinion, why it decoupled from the HDD players that we saw on Friday. And then let's think about the week ahead. So as we move, where should we go from here? I expect to see Micron kind of move sideways, have a bit of sideways chop in the early part of next week as the market digests this month-end rebalancing and Citadel's block inventory. We also have the ultimate earnings test next week. Now, I know we had a big one this last week, but guys, we have SanDisk and Western Digital on August 5th. Both will give us huge demand signs and signals for the sector. So mark that down in your calendars. You don't want to miss that. But the day before, on the 4th, we also have AMD, Asteria, Arista Networks. So we had some big earnings that will also give us signals that we can digest and try to better understand of where this trade is moving. That's what we're looking for next week. But in closing, for me, to wrap up this video, I would say whether you're a long-term bullish investor and you're bullish on the massive AI boom side of the debate, or if you're on the other side and you're worried that the hype and the high prices are pushing these stocks too far, the great news for all of us this week is that the forced deleveraging trading noise feels to be fading. And the institutional game playing, let's hope it's behind us at this point. So hopefully the real corporate earnings and the demand can take center stage again. And we can put the focus back on the actual business fundamentals and the long-term valuations for these companies. This week, in my opinion, removed one layer of uncertainty, but it didn't settle the debate that we have in the marketplace. Over the next week, the earnings and the guidance and the price action that follows those earnings and guidance will tell us whether this was simply a leveraged event or the beginning of a broader repricing of AI infrastructure. Guys, that's all I have for today. I hope you appreciate it. I hope you liked the video. Give me a like below, subscribe to the channel, drop a comment, and I'll see you on the next one. Take care, guys.